remember when I was 17 and I was filling out my uni application. I got to the part where it said help loan, just ticked some boxes and thought that's an adult problem. HECs is one of those set and forget things, but recently it has become quite controversial for all of us. No one ever really took the time out to explain it to us. It was all about ATAR and what uni you'd want to go to, not what you'll be owing at the end of it all. So what is HECs? I'm going to simplify this as much as possible and explain all the info that I would have liked to know when I was younger. HECs is a loan from the government, similar to bank loans for a car or house. They lend you money to complete your studies. It is only available to domestic students. The loan repayments are made automatically once you earn over $48,000. This amount changes each year. I will explain this a little bit more later on. HECs is known to be interest-free, meaning that the value doesn't compound or increase each week or month like a normal loan. Despite this, it is not that simple. These days, if you had a $40,000 HECs debt and you didn't start paying it off until years down the track, it is likely that your debt would have increased by a few $1,000 dues. So, this table on the ATO website shows the percentage of your salary that you'll be paying when you're repaying HECs. It is dependent on your salary such that the more you earn, the more you pay, and thus, the more you earn, the faster you'll pay off your HECs. However, you can choose to make repayments yourself if you'd like. There is a basic timeline when it comes to HECs repayments each year. With each of your pay cycles, you will receive a payslip that will say how much you earn and also how much is taken out of your pay and saved in a pot as your HECs repayment. This will happen each week, fortnight, or month, depending on your pay cycle, until you submit your tax return in about August. Once your tax return is filed, your HECs loan amount will be updated. Before then, there will be no change in this. You'll also notice that there is something here called indexation. Let's talk a little bit more about this. Indexation is here to ensure that the loan value is adjusted to take into account inflation. Essentially, it is like how the value of food and petrol is now higher than before. The government needs to make sure that the loan increases to match the value it was at the time it was made. The main takeaway is that HECs debt does increase. It increases on an annual basis on June the 1st, and the rate differs each year. Previously, the rate was generally about 2 to 3%, such that a $40,000 debt would increase by about $1,000. However, this year, the projected rate is 7.1%, such that the same $40,000 debt would increase by $2,840. That's quite a large difference. Of course, if your debt is higher, the indexation will affect you more. With this current climate, it was suggested that after 10 years with the average indexation of 5%, uni graduates with a starting salary of $60,000 with about 4% increases each year in their salary, and a HECs debt of $50,000, were likely to pay $27,000 in interest and still owe about $10,000 more than when they left uni, such that they were always chasing their tails. There are two ways to pay off your HECs debt. You'll be forced to pay it off once your salary hits a certain threshold. This will be done for you, as explained earlier. Remember that repayments will only show at the end of the financial year after you complete your tax return. I almost accused my first boss of not paying my HECs debt, as I couldn't see a change in the balance on the ATO website. You can also make voluntary repayments, where you choose when and how much you want to pay. It is a much faster process and will decrease your loan balance once it is processed. To check how much you owe on your HECs, you need to have a MyGov account linked to your tax file number and the ATO. Once that is done, it is a simple process as described here. Your balance will be shown with a DR behind it, meaning that it is owed to the government. You can click for more detailed information about the repayment amount and changes made due to indexation. The value will only change after your tax return is completed. To make voluntary repayments, just scroll down until you see the link. They can be made via credit or debit card, like what you do when you're online shopping, or via BPay, which can be done via your online or mobile banking with the codes provided. If you have ever needed to pay a parking or speeding fine, you may have used this before. Voluntary repayments have pros and cons. The good part is they are processed quickly and will therefore reduce the remaining debt, which may be affected by indexation on June the 1st. By paying your debt off faster, you also increase your ability to borrow if you are looking at getting a loan anytime soon. The negative is that it isn't that instant, so you will need to make sure that your payment is done as soon as possible to avoid indexation. Also, HECs debts are not transferable, so if you were to pass away, your debt would be cancelled. If you were to move to a different country and live there, you wouldn't need to pay it back, but rules on this may be changing. So, with the indexation being announced at 7.1% this year, what do we do? Of course, there are two sides to this. Many people say to pay it off, others say to leave it. I reckon it depends on you and your circumstances. Consider the amount of debt you have. If it's small, it may be worthwhile to just pay it off so you don't have to pay that extra amount. Do you have other money-making assets, whether that is rent from a property or even interest from a savings account? This may be adequate to cover the loss with indexation. Do you have future financial plans and need a loan? If you're able to invest the money into a business or an investment property that could make you more money, the decision is not that clear-cut. Let's finish off with 3 examples. All of them have 40k in HECs debt, but they have very different life situations. Person A has 100k in savings, and it is building at a rate of 4.2%. She has no plans to use her money. She would likely benefit from paying off her debt. Person B has 50k in savings, so if they were to pay off their debt, they would only have 10k as a safety net. If they were living at home without many expenses, this may be okay. It depends on their income and their expenses. However, if they aren't planning to pay off their HECs for whatever reason, I think they would benefit from putting their money in a high-interest savings account, as they aren't making too much interest at the moment. Person C has a lot of savings, but they're currently hoping to get a home loan for an investment property. There are 2 sides to this. By paying off their debt, they have a greater borrowing capacity, but less money for a deposit. If they don't pay it off, they may potentially have more money for a deposit, purchase a better home, in inverted commas, and start earning more rental income. In this situation, a discussion with a financial advisor or mortgage broker to crunch the numbers would probably be appropriate. Now, all of these are really just generalizations and may not be the right thing to do. Other things to consider are if you have other expenses or if you're living at home, will you need that money in the future, or is it just sort of sitting there? We also don't know what will happen in the future. Who knows? The government may abolish indexation for HECs. They may set it at a fixed rate. Only time will tell. So, I'd love to hear what you guys are thinking of doing. I know this has been a topic of conversation amongst my friends and has sparked quite a lot of debate. I don't really know if I've made my decision yet, but time is running out.